Central banks are fascinating institutions. They act as the financial backbone of a nation, sort of like a super bank for all the other banks. They don't have regular customers walking in for loans or to open accounts. Their customers are governments and commercial banks. One key role of a central bank is to control the money tap of a country, also known as monetary policy. Think of it like adjusting the flow of water in a pipe. By managing the money supply, central banks aim to keep the economy stable. They do this through tools like interest rates. Central banks also play a crucial role in ensuring the value of a country's currency. Imagine if the money in your pocket constantly fluctuated in worth. Central banks work to prevent this chaos and maintain financial stability. For instance, they influence interest rates to control inflation, which is the general rise in prices. Let's delve deeper into how central banks maintain the value of money. They achieve this by acting as the sole issuer of currency. In the United States, the Federal Reserve, the central bank, is responsible for printing and distributing dollars. This centralized control prevents counterfeiting and ensures a stable money supply. Central banks also function as lenders of last resort. When commercial banks face financial difficulties, they can turn to the central bank for emergency loans. This safety net helps prevent widespread bank failures and financial panics. Furthermore, central banks manage a country's foreign exchange reserves. These reserves consist of foreign currencies and gold. By buying or selling these reserves, central banks can influence the exchange rate of their currency, making exports more or less expensive. To illustrate their importance, let's look at examples from the USA and the UK. The Federal Reserve in the US played a critical role during the 2008 financial crisis. By providing liquidity, access to funds, and lowering interest rates, it helped prevent a complete economic meltdown. Similarly, the Bank of England, the UK's central bank, intervened during the COVID-19 pandemic. It implemented quantitative easing, essentially creating new money to buy government bonds, which pumped money into the economy and supported businesses. These examples highlight how central banks act as economic guardians, stepping in during times of crisis to stabilize financial systems and prevent widespread economic hardship. Their actions have a direct impact on businesses, investors, and individuals alike. Central banks might seem distant and irrelevant to our daily lives, but their decisions affect us all. Their policies influence interest rates on loans, mortgages, and savings accounts. A small change in interest rates can have a ripple effect throughout the economy, affecting everything from job creation to housing prices. Understanding the role of central banks empowers us to be more informed citizens. We can better comprehend the economic landscape, make sound financial decisions, and hold these institutions accountable for their actions. In a world of complex financial systems, central banks play a vital role in ensuring economic stability and promoting sustainable growth.